Welcome back to the channel, and welcome to today's Crypto Daily Roundup. Prices have moved, narratives are shifting, and a handful of stories today actually matter. We'll start with the quick market snapshot to set the board, and then we'll dig into 3 signals worth your attention. US regulators sketching a path that could transform market access, a politically branded Bitcoin miner learning that hype doesn't equal cash flow, and Abu Dhabi laying down rails for regulated derivatives that could pull in the next wave of institutional money. Let's get you calibrated. Bitcoin is trading close to 110,000 after testing both sides of the range. It tapped just over 112 before slipping back, and it's been jittery around that line ever since. It feels like the market knows this is the make-or-break hinge level short-term. Ethereum is steady in the low 4,000s, soft on the session, but still carrying that institutional bid feel. Every time the macro tone leans dovish, ETH reacts faster than Bitcoin. And that's not noise, that's narrative. XRP is hovering at $2.80, coiled but quiet. The $3 level is still the magnet, but we'll leave it at that today. No overkill, just context. BNB is holding in the mid-800s. Solana is defending the 200 handle. Dogecoin has settled back to around 21 cents after last week's brief pop. Cardano is parked around 80 cents. Tron is 33 cents and grinding sideways. Toncoin and Avalanche are both basing. That's your tape. Not a panic tape, not a breakout tape, just a waiting tape. Now, the stories that matter. First up, policy. The US Securities and Exchange Commission has put digital assets squarely on its rulemaking agenda. This isn't another lawsuit. This is the beginnings of an actual playbook. On the table are definitions for what counts as a security, possible safe harbors for token distribution, and, crucially, potential pathways for digital assets to trade on national exchanges and alternative trading systems. That would move crypto from the shadows into the same market structure that underpins equities and ETFs. Why it matters. Liquidity follows clarity. If broker-dealers, ATSs, and national exchanges are given a clear lane, the universe of allocators who can touch this market explodes. Compliance stops being a bottleneck and becomes just another checkbox. That's when you stop guessing and start allocating. We're not there yet. This is an agenda, not a final rule. But direction is everything. For the first time in years, the posture isn't, "We'll see you in court." It's, "Here's the path, walk it." That subtle pivot can unlock confidence before a single rule is finalized. Desks start planning, institutions start modeling, liquidity starts preparing. Policy design, not improvisation. The nuance here is critical. Every prior US cycle has suffered from ambiguity. Projects raised money without knowing how to register. Exchanges listed assets without knowing what was off limits. Institutions stayed on the sidelines because legal departments couldn't give a green light. If this agenda becomes rule, those frictions start dissolving. It doesn't mean crypto suddenly becomes risk-free, but it does mean risk becomes quantifiable. That shift alone changes who can participate. Next up, Wall Street meets politics. American Bitcoin, ticker ABTC, launched on NASDAQ with Trump family interests tied in and Hut 8 as a major shareholder. And almost immediately, the stock stumbled, slipping below its IPO price. That's not a partisan story, that's a market story. Branding can create attention, but it can't override the economics of mining. This industry is brutal. Margins swing wildly based on power costs, machine efficiency, downtime, and treasury decisions. If a miner can lock in cheap, reliable energy, keep their fleets modern, and manage their balance sheet well, they thrive. If they can't, no amount of celebrity association saves them. Public markets are even harsher referees than token markets. In token land, hype can run for weeks before liquidity fades. On NASDAQ, mispricing gets punished within hours. That's exactly what happened with ABTC. The lesson is simple. Execution beats spectacle. Investors want to see numbers, not names. The takeaway is bigger than this one stock. Crypto is going to see more attempts at crossover. Celebrity-linked tokens, politically linked ventures, public listings that lean on brand power. Some will succeed because they pair the story with a serious operational plan. Others will fail because they treat branding as a substitute for fundamentals. If you're trading or allocating in this space, keep that lens sharp. Always ask whether the story is being backed up by execution. And finally, the most important but least flashy story. Abu Dhabi's regulator has given GFO-X, a London-born crypto derivatives platform, in-principle approval to operate as an exchange and a central clearinghouse for digital asset derivatives. Why this matters is simple. Derivatives are the liquidity engine of every mature market. They allow funds to hedge, speculate, and scale exposure efficiently. But most large institutions won't touch crypto derivatives unless they are cleared, supervised, and backed by familiar rulebooks. That's exactly what this approval points toward. London authorization on one end, Abu Dhabi clearing on the other, and recognizable intermediaries in the middle. That's how you build rails that can actually carry institutional flow. It doesn't mean the perps market disappears. It means there's a parallel lane where traditional funds can finally size up without compliance nightmares. That's how liquidity deepens, spreads tighten, and the wild air pockets we see on headline days gradually smooth out. Zooming out, Abu Dhabi is competing with London, Hong Kong, and even Singapore to be the friendliest international hub for digital assets. The playbook is clear. Offer rules that institutions can accept, provide approvals for exchanges and clearing, and recruit global names to anchor operations. We're now seeing the first signs of that strategy paying off. So how does all this tie back to the market we're staring at today? Bitcoin sitting around 110,000 is the nervous but resilient tape you'd expect ahead of major macro data. The US jobs print coming tomorrow will likely set the tone. A hotter number pushes the rate cut fantasy further out, cooling risk. A softer number lets markets breathe. Either way, Bitcoin is stuck testing conviction around one level that everybody sees. Ethereum remains the better gauge of appetite. Even on down days, the trifecta of ETFs, staking, and on-chain activity makes it sticky in institutional portfolios. We saw in August how asset managers rotated out of Bitcoin chop and into ETH for yield and clarity. That wasn't a one-off. It's becoming a behavior pattern. Altcoins are basing rather than breaking. Solana at 200 is a constructive anchor. Dogecoin at 21 cents is a shrug. Cardano's sideways drift is exactly what ADA does before it joins a rotation. Tron keeps moving stablecoins. Ton and Avalanche are consolidating quietly. The important part, there's no panic. This is a market waiting for clarity, not a market spiraling. Let's make this practical. If Bitcoin holds 109 to 112, that's the range you play. Acceptance above it puts shorts under pressure. Slipping below it opens the door to tests lower. For ETH, 4,500 is the magnet level that flips grind into acceleration. For XRP, 280 to 3 is the only pocket that matters. Solana is all about defending 200. Dogecoin needs 22 cents with volume to prove its latest narrative. Cardano needs a weekly close above 90 cents to shed the laggard label. Those are your tripwires. Not predictions, but signposts. Now let's close with the big picture. What does today actually tell us? It tells us that rules are being written, not just enforced. It tells us that brand without fundamentals won't cut it in public markets. And it tells us that international hubs are racing to provide the rails that will let institutional liquidity flood in. Put those together, and you get a maturing market that still has volatility, still has narratives, but has far stronger scaffolding underneath than even a year ago. Quick sponsor reminder, protect your crypto. If you're holding Bitcoin, Ethereum, XRP, anything, don't leave it sitting on exchanges. Get a Ledger hardware wallet and take control of your keys. The link is in the description. That's today's picture. Bitcoin resilient but nervous. Ethereum sticky with institutional support. XRP waiting at $3. The rest of the majors basing. The SEC sketching a lane. A Trump-linked miner learning that Wall Street doesn't reward noise. And Abu Dhabi wiring up derivatives for the next wave of money. Make sure you're following us on Spotify for the full roundup. And as always, we will see you at the top.